A fever has broken across the broad indices, but the patient's pulse remains irregular. The S&P 500 posted a clean close in positive territory, while small caps coughed blood on the downside. A divergence that screams sector rotation rather than true recovery. Here is what threatens your portfolio today. Earnings season approaching without earnings clarity. The specifiers are breathing unevenly. ARKK exhaled hard at 1.77%, while MAGs inhaled with 1.41%. The semiconductor specialists, SPHB and XLI, showed respiratory distress, with the biotech sector, XBI, coughing up 3.0% as speculative capital fled defensive positions. The data is screaming that greed has rotated into caution. Capital moved from high beta plays toward established moats. Our metrics confirm speculators are no longer blindly chasing momentum. They're calculating risk-adjusted returns before committing. Credit markets are running a low-grade fever despite the broader technical improvement. The 10Y Treasury spiked to 4.57%, 0.66, while high-yield yield spreads, high, HYG, HYGW, all tightened by fractions of basis points. This is the circulatory system tightening around the body's core. Capital is pulling back from periphery sectors into central assets. The consensus among the Canary community is that credit remains stable for now, but the rising yields indicate institutional demand shifting toward duration rather than yield-chasing behavior. Fear has collapsed to near flatline levels across all volatility proxies. UVXY dropped 3.98%, VIXY shed 2.54%, and VXX flattened at 2.58%. The VIX itself crashed from 1503, down 11% in a single session. The indicators are signaling that the market is cooling off faster than fundamentals warrant. This isn't confidence. This is complacency setting in as volatility compression creates false security. Our data indicates investors are pricing out further downside, while underestimating geopolitical tail risks. The economic engine shows bifurcated performance. SMH and Canary held ground with 0.37% and 0.75% respectively, but the mid-cap engines, IWM's 0.33%, IY 0.43 kills are running on fumes. Industrial sector, Canary, outperformed while transportation lagged, suggesting manufacturing is stronger than services. The Russell 2000's 0.49% drag confirms small business fundamentals remain soft despite headline S&P gains. This is the difference between a healthy heart and one that arrhythmia. Broad measures mask micro-level stress. Safety assets posted marginal outperformance as insurance rather than armor. GLD dipped 0.4% while TLT barely twitched, but XLP consumer staples climbed 0.85%. The immune system responding to anticipated exposure rather than active defense. However, there's a signal here that changes everything. The muted flight to safety combined with rising yields indicates institutions are hedging against inflation re-acceleration, not recession fears. The real danger isn't crash risk, it's duration mismatch in portfolios built on low-rate assumptions. Your portfolio is the hero, but inflation recession risk remains the villain. The S&P 500's modest gains hide a fractured battlefield, tech and industrials holding ground, while small caps, biotech, and speculative sectors bleed. Credit tightening plus fear compression, complacency before pain. The next 2-3 weeks of earnings will either confirm this as a technical correction or expose deeper structural weakness in the real economy. The fever broke today, but the patient still runs warm. Position for volatility expansion on earnings rather than chasing today's relief rally. The Canary dashboard shows cautious optimism with defensive posture. Canary report, where data sings before markets crash.